you for participating in this panel. But I think it's a very good, very diverse panel because we have Ravi. Gururaj doesn't need an introduction. He's one of the super angels in India, has been an entrepreneur. He's a very active angel investor. And Ravi is part of Microsoft. He actually heads the accelerator program. So we have an institutional view. We have Radhakrishnan, we've heard him. He's been an entrepreneur. So what we try to do is we try to get 3 different perspectives on the angel fundraise. I think, and I will try to keep the questions minimum and I'll kind of open it up to the audience. We have a time stop at 3:40 because Ravi has to leave. So I will try to keep 1 question per person and then we'll open up to the audience. Right? So starting with Ravi. So basically we've kind of heard about a lot about angel investment through the morning and about entrepreneurship. Right? So as an angel investor, just kind of wondering, what is the one trait which you think in an entrepreneur? When you see that is not the only trait which gets him funded, but if that trait is missing, you will not fund the entrepreneur. So what is that one deal breaker for you as an angel investor?
So I tend to fund teams, so that I'm not trying to make an individual bet only. But I'm glad to mentor or talk to somebody who's an entrepreneur. But for me, if you're to make a decision, there should be some level of a team together that's committed to doing something. It should be reasonably complete. There may have to be somebody who's going to sell this product, who's going to be acting as the product manager for this, who has the product vision, let's say, if it's a product, and somebody who can build it. Sometimes it's the same person that's doing all of those, and and they have some people they've been able to bring on board with sweat equity or with their own cash, whatever. That's fine too. But mostly it's about finding something that looks like a team, that looks like it's got some potential, and they will demonstrate something. I mean, what I don't want is just a paper plan. No, I also paper plans myself. I could be an angel investor all day and night. What is the difference is somebody else is going to do it and they're going to execute. And do they have a chance at succeeding at this? Is the plan viable? Does it meet the smell test for me? And then can I really help them? So I never invest in something which I don't understand, that I have no network to help them, where I have no domain expertise, where I have no point of view. That's like, I'm not an apathetic investor. That's okay. I'm not just going to write a check and then just sit aside, right? At the same time, I try to avoid being an interfering investor too. So there's apathy and there's interfering. Both of them are bad, right? Because if you want to be so interfering, you should just run the company yourself. Why are you being an angel investor, right? So there's a balance to be struck there. And so for me, it's about, is the team credible? Can they build what they're doing? What they say they'll do? Do I align with what they do? Sometimes the plan is good, but I don't believe it. Or I don't believe in that area. That doesn't mean the plan is bad. It just means my thinking is off, right? And so those are the things I try to find. Obviously, there's a team, market, and all that. There's all those next level. After you get that past the first hurdle, right?
So I think we talked about the same thing in the morning today. I think as an entrepreneur, it's kind of good to hear this because you want to take money from angels who want to be invested in your company and who want to contribute in some way. Just not bring in dumb money, but actually bring in very smart capital to your startup. So thanks. So for Ravi, just to kind of so we know that Microsoft accelerators are probably one of the best accelerators in the country, with the value they bring in and as well as the environment they bring in for entrepreneurs. And you see, we actually see a lot of startups emerging from there. We also see a lot of startups not getting funded, right? So we have actually probably the term. So basically, much later into after having come out of the accelerator, they're still looking for funding. So what do you think is one of the reasons they're not able to raise funding? What has been your kind of understanding in that space?
I think we do a fairly good job of finding startups that are aligned to getting on to the global markets and building products that are going to have that kind of reach. but I think the maturation process is much longer. In fact, we as Microsoft Ventures in India are probably the most active in the alumni space as well. We spend a lot of time with the alumni. So while they come in and spend 4 months there, so there's a hugely intense program, they make a huge shift in the way they think, the way they're going to build the business and so on and so forth. There's no guarantee that at the end of the 4 months also there will be a term sheet waiting for them. It just takes much longer to do that. Because that's the way the investors are, that's the way the startups mature. So I feel it's just a matter of time that all of them will eventually get to a point where they will be able to excite investors and be able to tell a story that gets most of the other stakeholders around them aligned. So, but I think there's no particular reason for that. It's just, I think it's just a matter of time that it will happen, and probably it will start shortening as we go along.
So we have kind of heard the investor perspective, right? So what do angel investors look for in startups? So as an entrepreneur, right, what is your advice again to entrepreneurs looking to raise funding, right? Looking to raise in VC funding, right? So what is the one thing which again is a deal breaker for them? So sometimes we think just because we're taking money, we can take money from anybody, right? So somewhere you have to be judicious about the people you're taking the money from, because it could help or it could make or break your startup. And so what is your kind of one again deal breaker which you would never sign a term sheet with?
That's a tough question. Like I mentioned earlier, you always have a list of potential VCs who like to align with. But it happened for me in Series A, but then in Series B, again a list of potential investors I wanted to go to, but finally ended up going to as many VCs as possible with them because the market is pretty bad. So there is no criteria, I said, but it definitely helps if the VCs understand the domain better. That's something which I definitely look at. Like I said, mentioned earlier, it's always good for entrepreneurs to, like VCs do a validation of entrepreneurs. It is good for entrepreneurs also to have an understanding of what VCs, which are the VCs they want to tie up with, who could add more value to them. I think that's a critical point. I just want to ask one more question about this. While it's good that a lot of accelerator programs are coming in, I think my biggest concern would be the lack of mentoring, actually lack of mentors. I'm hearing big numbers thrown up. Everybody wanting to accelerate a huge number of startups, but I think the concern is, which I have as an entrepreneur, is who's going to guide them? Because I've seen a lot of my ex-colleagues who are, like I said, this typical model, 10 lakhs, 10% and stuff like that, but after they get it, they're stuck. They don't know, they don't have anybody to guide them. I think that's a concern which we need to really address.
Yeah, I think it's a real concern. I mean, it's the one area of the ecosystem that hasn't scaled. I mean, at least, okay, I don't think we can definitely have more accelerators downstream, but you need to do them in commensurate with the mentors, the VCs. Otherwise, it's no good. You're just priming the pipeline, but nothing would happen at the end of it, right? And I think that's a good, fair point. I think we need. Hello. Okay. So we need, maybe to wait a couple more generations, which is we'll have, Silicon Valley wasn't built overnight. It took a few decades to get there. I think we need to have, 3 or 4 generations of entrepreneurs, a few entrepreneurs who've exited, give them put time into mentoring and angel investing and all that, right? Right now, we don't have enough of that ecosystem around us, right? When you get to they're trying our best. I mean, NASSCOM can't produce mentors, right? What we can do is aggregate people who are interested in mentoring companies. We're trying to do that. But not always is interest equivalent to useful mentoring. This is where you have to be a little careful, right? I mean, so I think we work with a lot of the accelerators now. So one of the things we try to do is get the best companies to Website or wherever, the other accelerators, so that they have programs as well, right? I mean, I think collectively as an ecosystem, we can get people there. I think, but it's definitely a big gap. There's definitely areas, And I think Microsoft does a good job. They've got a good list of mentors, but they've got a good brand, and other people don't have that brand. Accelerators to bring people in their own customer network. And, they've got a big team, and they're able to do it. But most of the accelerators have still not been able to get to that level yet, in my opinion.
Just to add to what Ravi said, thankfully for us at Microsoft Ventures, we do have a little bit of problem of plenty. We have a lot of mentors. We don't give them enough startups to work with. So we're now beginning to get some alumni also to start working with them so that they can get the benefit of the mentors. Now, having said that, I've been in the mentoring space for some time. So having a person with these skill sets is not enough. One is to find them and to. So one of the things that happened for India some 5-7 years ago was that a lot of people who had built startups in the US came back and they were happy to start, jumpstart this whole thing. Now, out of those came some early exits, and those people are now beginning to come back and sell. So it's going to take some time, but the fact that you have the hard skill sets, you understand the industry, you understand sales very well, and can help somebody with sales kind of questions, it is great. But also I think there is a sensitivity about how you mentor versus how you instruct people, how you prescribe to startups how to go about doing certain things. It's a soft skill that you have to learn, and when you're in your late 40s or 50s, you now learn a newer skill of how to energize an entrepreneur versus instruct him. It is a interesting problem to or interesting skill to pick up. And some people do it well, some people don't do it as well. So some of these things that we take for granted, say in the Bay Area, where people have been entrepreneurs themselves and therefore can empathize and partake these kinds of advice, versus somebody who's come from the corporate industry and thinks that they can do it, is not necessarily there. So I think it's just a matter of time before we get more and more of such mentors coming into the system.
The other big problem, there isn't an economic model yet for mentorship. Okay? So problem is, I angel invest and I mentor, but I mentor the companies I angel invest. So because I have an interest in those companies, right? But the other ones I can't do every one. And sometimes I see some companies come to me and they've given away 15% of their equity for some advisor. I'm like, that's not done. I don't know why that advisor took that much in the first place, and I don't know what this company is thinking they'd get for that much equity given away, right? That early in the game. So I think there needs to be, companies also need to be educated on this, and maybe Let's Venture will start to do it. How to work together an advisory board of, how an advisory board should be put together, what should be the mutual expectations, what is the reasonable level of equity to give to an advisor, and it should also vest over time. It shouldn't just be given up front and they're going to give you 2 business cards and you're done, right? It should be a relationship that is sustained, and then maybe that can help you. It's like we had a good model that was established, and people felt like there's a way to get involved. So then you can get younger mentors involved who may not be able to invest, but can actually help, and that could be actually more valuable than older guys and mentoring, right? People who are either the engineering side of things, the design side of things, customer acquisition, growth hacking, could come and help a company get to the next level in their free time, and they also benefit from some upside, economic upside, And so and we haven't seen that evolution yet, and I think it's a gap.
So this is a very important point we touched on, right? The mentoring. So a lot of times you don't know what is the scope of mentoring, right? And you expect too much from a mentor, right? So sometimes you look at coach, mentoring, and then consultant, everything into one. Probably the person is giving away his core business expertise to you in the name of mentoring, but he could actually come in as a business consultant, right? So somewhere I think it actually startups sometimes also leverage that mentoring word and try to take a lot of free time from the mentor, right? So
Yes, so I tell you how, when I talk to companies, I tell them these 5 things, right?
Yeah.
I can help you possibly with raising capital. I can help you with trying to get the customers. I can help you with getting colleagues and co-founders.
Yes.
I can help you with some amount of community outreach. You know, these are the, and I'll help you with coaching. These are the 5 C's. And I can't do all of them for everybody. And I'll do some of them at different stages of time. And I'm not going to guarantee you anything. In the sense that I'm not going to be your salesperson. I'm not going to be your fundraiser, per se. But I'm going to genuinely help you with these 5 dimensions. These are the 5 dimensions every mentor should help on, in some way or the other. You know, in some industries, depending on what they're doing, I may not have a customer database that I can send them to. And, you know, I can't send the VC friends every investment I make right away. It doesn't work that way. I tell the angel investors, the angel companies too, just because I put money in now doesn't mean I'm going to refer you to Sequoia next morning. It doesn't work that way. You've got to wait, you've got to hit your factors, you've got to hit your numbers, and only if I feel comfortable will I send you across. Because when I make a referral, I want it to be a valuable referral and somebody should feel my email to them is credible. They'll pay attention, right? Otherwise, it loses its value. I'm just spamming them. So these 5 dimensions, I'd say, you know, and companies should also look at that, founders. They say, what will this mentor deliver on these 5 levels? You know, can they get me into the newspaper? Can they get me into a talk on a panel somewhere? Can they get me some coverage with, you know, that could one the community aspect, right? So I think all these other 4 are very clear. Community may not be as much, you know.
So I think I try to open it up for questions because we don't have much time. But I think Ravi made some very good points, right? So as founders of companies, like what is it that you can expect from your mentors, and you know, how do you actually leverage your mentor so that you maintain your credibility along with the mentor's credibility? And I think it's very important to make that differentiation because there are a lot of self-proclaimed mentors in the ecosystem, right? So even as entrepreneurs, just as Ravi was mentioning that you have to, we talked about that referral check is a WhatsApp away, right? Even as a founder, for you, the mentors, you should check with people who have been working and you will clearly know who are the people who are good, who are actually not so good, right? As well as incubator. Radhakrishnan also talked about incubator, accelerator, right? In terms of the value. So you should go back and check. So 10% for 10 lakhs, you have to go back and really look at all the value they bring in before you commit yourself.
And I say, even when you get a mentor as an advisor, don't give the equity right away. You don't have to. What I say is, the mentor's trusting and you're trusting of them. The value will be created, and then there will be a right time at which you see there's a fit. So it's like you can have an engagement period, then you can get married. There's no need to get married up front. Some mentors will say, sign this paper, then I'll do it. Walk away. That's not the way good mentors will work. They'll work with you for 6 months, 4, 5 months, but then you should also be equally trusted. You shouldn't then say, oh, now that you've helped me raise the money, forget it. You might have a verbal deal, but there's no need to codify that. You will have an agreement that will work for 6 months. Then we'll see, okay? And nothing should ever get into double digits or anything, okay? Should all be very low numbers. Please, otherwise you'll mess up your cap table forever. And you'll find you won't be fundable. And I can't see what mentor would want to take double-digit equity, right? There's not that value cannot be delivered, unless they're putting in crores in your company.
So, is there? My name is Prashant. Is there a model for splitting the pie? There's a book called "Splitting the Pie" or "Slicing the Pie." So, I think it's more of use. Developed in the valley. So is there anything similar here, like how much you give to somebody who's an advisor or somebody like that? Is there like some kind of model or just a ballpark figure? Or?
So there's no set model of any kind that I've seen. All I would suggest is take baby steps first. Don't do anything that you're not comfortable with. Don't jump into the unknown unless this person is comes to you very highly referred by friends that have had a similar experience to what you're looking for, right? It's very rare. Otherwise, because even the mentors don't know whether they can help this company or not. Sometimes I'll start talking to somebody, I have no clue, that company oftentimes will have some founder dispute and all that. Why do I even want equity in this company? Or, They haven't even got off the ground yet. So there's no point. And oftentimes I like to actually get into a company when the VC or an angel group is coming in. That's actually the simpler point at which to codify. In the last 3 deals I've done, we just had an informal agreement. And at the time the VC came in, I got both I made an investment and I got some advisory. And it's very clean then because the VC didn't object, right? Because otherwise the VC also looks at the table and says, why are all these bozos on the table? What did they do for you? And what are they going to do going forward? Yeah, and then it's a mess. You can't get them off the table now. Finally you got a VC. You got to the point where a VC is interested in investing, but they want you to clear out all these guys. And all those guys will hold you hostage there. Okay? If they're the kind of vendors who took a lot of percentage in the first place, they're not going to exit easily. And guess what? They're going to want to exit at the valuation the VC is coming in at. That's the other thing. They won't understand that the VC is coming in on a forward-looking project, not a backward-looking one, right? So be very careful with this. Going too early with advisors. I would say to your question, is there a well-known kind of campaign?
There's a book called Slicing the Pie.
Yeah, obviously.
Is there any similar model?
I'm sure there's another book called Growing the Pie too. It has to be. I mean, the next thing everybody say, why? Don't worry about your slice the pie, let's grow the pie. That would be much better. So, I haven't read that book, unfortunately, but I think you're right. I mean, in the sense that there are elements, there are stakeholders, there are founders. Within founders, how do you split the pie between co-founders is a problem. How do you set that up? The capital structure of a co-founder agreement is very important too. That messes up a lot of companies, right? In the next stage, I'm sure you know. How do you do it? Many companies are multiple people in the team, right? And I think this is where accelerators are a good point, which you go in maybe with a clean cap table, which is almost like it's a founding team that hasn't even split up the equity. During those 4 months, you realize strengths, weaknesses, interest, alignment, bonding, all that, and then maybe at the end of that, you might have a way to make a decision. And some elders also helping you discuss, right? So co-founders, early friends and family, how much equity do you give them? Advisors, the first angel, that comes in. Oftentimes it's a little bit more than friends and family, the first angel. And oftentimes people again mess up the whole thing right there. And it's completely unresolvable after that. And the problem is this, once in a while you'll get a hit company. Okay? Most of your ideas will go nowhere. And that one company will have this mess up, Murphy's Law. And then you won't be able to take the next level. And that's the shame sometimes, because you'll waste a lot of time trying to clean up. And investors coming in don't want their money going to previous investors. Generally, they want the money going to the company. So it's not like they're going to write a check. I'm going to write a check for X lakhs, and half of that is going to pay the previous investor, half is going to the company. Doesn't work that way. I don't want my money going to the previous investors. It's not good for it. It's not a useful use of cash, right? So you got to keep that in mind, when you do this.
So I think just
So how the valuation of a company is calculated even the startup stage?
So I think I just want to kind of add a point to what Ravi said, right? So when you start a company, think big and think professionally, right? So don't get uncle, auntie, father-in-law, mother-in-law on the cap table, because they are not people who are operating the company. So you have to think big. Do not think small and think that it's a small outfit I'm trying to run, so it doesn't matter who comes in, right? So actually think big and think professionally, ask for help. There are a lot of people who are willing to give half an hour of their time to explain to you how it works. But I think you need to ask for help.
Yeah, so your question was about valuation. How do you value a company? Okay. So first of all, I think the valuation, so whatever we talked about just now is more about a transaction that could happen when the funding happens or a mentor comes in. And these are all good things for you to happen if you're building the company very well. You have to focus on getting the customers, getting the traction, getting the right set of people to the team, so on and so forth. That continues to build your valuation. Now at some point in time, you will have to go out and seek funding from the outside, so that now when they bring in the money, there is a certain valuation that you go in, pre-money valuation, and then there is a certain dilution that goes with it. Usually in the very early days, it's very difficult to place a valuation when there is no revenue, just a product, a prototype, and so on and so forth. At that point in time, I think it is more of an art than a science as to how an investor and you where it is, how desired are you, desirable are you, and how much they want to get in, right? There are certain formulas, but it all depends on the state. So I don't want to give you a number and then you say, oh, I didn't get that, right? But I think it becomes more of a science than an art much later when you have certain revenues, maybe profitability, predictability. Then it's easier because VC will say, if you have done $1 million in revenue and we have an EBITDA of say 15%, that's fantastic. I want to come in, I want to now invest in the company, and I want you to do 100 million at the same EBITDA, and I will value you at this. So I'm not giving you any specific numbers because I don't think that will sit well with all the different types of startups at different stages, different spaces. But there are certain numbers that we can talk about specifically if you have any questions regarding that.
One more point. Actually, one good thing which is happening of late is segment-specific funds which are coming, like people on and stuff. Do you see a trend among angels also, a core group of guys who are specializing in a particular segment coming together? Because very often you see government announcing venture fund, cutting across all segments actually, and for a very small amount actually. That doesn't exactly work actually. So you see the trend emerging among angels also.
So on our platform, when we kind of onboard an angel investor or a fund, right, institutional investor, one of the questions they answer is which sector are you looking at? Right? And most of the angel investors talk about their sector. So just like what Ravi said, right? He probably will look at internet, cloud, mobile, which he understands well, and those would be the sectors he would invest in. Right? So most of the angel investors, so the experienced angel investors know which sectors they want to focus on because they've kind of understood the art of angel investing. A lot of new angel investors will say agnostic sector, right? Because they will go with who they feel comfortable with investing in. So if I'm a new angel investor and I know Ravi will make the right decision, I'll probably go with him in my first 1 or 2 investments. Right? So it is actually, and this could evolve over time. But we're also seeing a lot of funds coming up, like Snapdeal is now announced and they just came onto our platform. So they've created an institutional fund. Right? So one of the things which they said is they want to align with businesses. They don't want to get into a business, invest in a business where Snapdeal could actually compete later on. So Kunal was very clear, he doesn't want to get into that space. Right? So everybody has a thesis based on what value they bring in, what are the markets they want to look at. So it actually seems to be emerging quite a bit. But again, the new investors are agnostic.
When you're raising funds from friends and family, which is recommended, debt or equity?
If you can get debt, probably cleaner. But it's a little unfair to the people because unless they're collateralizing with your house or something, it's the downside of debt is they're not going to get repaid, right? I don't know how you're going to secure it. If you can secure it, debt probably makes sense. If it's debt and they're very rich and they don't care, it's almost like a grant, then great, take debt, then you can repay them and clean up the cap table before. I would, if you take debt, maybe take it as a personal loan, and if it's not secure, maybe you take it as a personal loan from them and put it into the company. That way there's only one person on the cap table, one person involved with the company, not like all kinds of instruments with different people, right? That can cause problems also later downstream, right? So keep it clean.
Okay. If it is equity, then when should it be allocated? During the first round or like earlier?
You'll have to allocate it when you recognize it on your books as equity, right? The funds will come in, your accountant will tell you it has to be recognized at some point if it's equity. When money comes into the company, it will come in for a purpose. There will be a statement on the memo line, say for share capital or as debt.
Or something like convertible debt?
You could take debt early and then convert it into equity later. That's also a possibility. So the way to do it maybe in the family is take some debt and then say some portion of that I'll convert into equity. But do a lot of family members in the cap table make any sense? To me it doesn't, okay? you'll have to clean up that problem later. So you may as well find a way to structure so that it's clean. I'll tell you one secret is, even if you're a founder, you do have some private friends and family money. If you can funnel it through yourself, so only you show on the cap table, that's cleaner sometimes. As long as it's not going to end up in a dispute, okay? I mean, as long as you can, that way at least the cap table looks clean, even if you had to get, and it looks like a personal investment, right? From you.
Thanks, Ravi. So we talked about how we need minimum cost to start up companies, right? But when we talk about hardware companies or companies that are focusing on consumer electronics or in IoT, so how does that fit? Is it? We can't compare IT companies starting up to hardware, right?
So I think IoT is now a hot area. So actually one of the areas where a lot of investors are going towards, because Google has actually said that they're going to do IoT acquisitions, and everybody is looking at IoT getting into the life of the consumer, right? So I don't know if you guys saw this, but this wristband which you kind of wear, the wearable, the Fitbit, right? So when the San Francisco earthquake happened, right, they said Fitbit actually got into the bedrooms of people, and they knew what time they got up and what that time they went back to sleep after the earthquake and how many people stayed awake. So that is consumer behavior, right? So people are actually now that wearable device hardware space is actually getting hot because they're associating that to getting to know of consumer behavior which you could not have known if that person did not have the device on him, right? So that is one part of it. But I think again hardware is again capital intensive. So it depends on the type of hardware companies, right? So we see a lot of hardware companies. Of course, preference is on internet and software, and which is scalable, which does not need too much of initial capital to kind of prove your idea. I actually have founders who have been working on a device for the last 2.5 years. And he was actually building a medical device where you could use the device to get the pulse of the person when you kind of take blood from the veins for the ICU patients, right? And they actually went to 3 iterations of their device because of the size. So they were trying to optimize on size, weight. So it is a longer process somewhere. So it is the initial kind of process is longer, it is more capital intensive. Right? So the nature of the business is that it is not very exciting to an angel investor.
Let me just add to that. Yeah. So just to give you some larger perspective of funding per se, when you're raising funding, the important question is, what is this funding being used for? So it could be IoT, it could be software, it could be anything else. So the question here is, if you are going to apply this money towards creating certain amount of value, be it software, be it creating some kind of an intellectual property that eventually will sell, to the point of the IoT, for example, in the initial stages, it's all about that. So there's no distinction between the use of funds for building the software or for the hardware. It's all pretty much the same. Now, having built that in the early stages, you built the technology base. Now, the next set of funds may actually be raised, especially from a seed fund or a VC, is for the marketing, because the initial technology has been built. It's the marketing that you are raising money for. At that point in time, when you are actually bringing in the IoT back as a hardware component, it's very possible at this point in time that you don't need to raise money for the IoT manufacturing and stuff like that. All that money could be coming from a debt instrument, not an equity instrument, right? So it's securable. Or there are banks such as Silicon Valley Bank that will come at the heels of a equity investment and put in some amount of capital expenditure kind of expenditures. So if you want to buy laptops, manufacture or whatever, all those things pretty much they can get their hands on some fashion, and there is a resaleable value, they will be able to do that. So I think it depends on where you are. In the early days, it doesn't matter because your PCB and your early days of testing the signals and testing all these things, it's no different. You're still creating technology in the investor's mind.
Mansoor from Steady Technologies. It's a startup company. So, this simple question. What type of agreement they have signed in between startup and an angel investors? What type of agreement? Or whether you are signing for a product or for a company?
So the name of the agreement is called term sheet. Right? So if you just Google term sheet, you will get a lot of different kind of things. So basically it's a legal agreement. So basically first you sign a term sheet, which is the intent to invest. Right? And you agree on, there are about 4 or 5 parameters, which is actually a completely different discussion, but you agree on 4 or 5 parameters and that is the intent to invest. When the term sheet is signed off, you kind of, once you have negotiated all of those terms, then you sign something called a shareholders agreement, where you actually make it, so the shareholders agreement is a legal binding agreement on the founders and the investors. So till you have not signed the SHA, until the money has not hit the bank, right, the funding is not complete. So just because you signed a term sheet does not mean that the money, you will get the money. So that's the way the process works. Ravi, you want to add to that?
So whether you are signing for a particular product or a particular company?
No, it is for the company, right? Because the product would change, the market would change, right? So it is between the company where you would also have a founders agreement. So there are a lot of other instruments which are actually part of the startup, right? So you will have the founders form the company, right? Founders with the advisor, all of them will actually appear on the cap table, and then you sign an agreement with the angel investors who are coming in. And the term sheet is the letter of intent, and the SHA is the final signed legal document.
So,
I think this question was whether you have an agreement for that one product or with the company talking.
No, the agreement is for the company. It's always for the company, because any liability which comes on the company comes to all the shareholders of the company, right? So it is always for the company, because the product could change, right? So tomorrow you could actually decide that you don't want to do the product, you want to do a new product, or you want to pivot it. But it is the entity, the legal entity which signs the document, and you are a signatory authority of that legal entity.
Just add to what he said. So the company is a consolidation of all the intellectual property that it owns, all the products, whatever products you build or will build in the future. Plus, at the same time, it represents the interests of all the shareholders of this. So it could be the angel investors, it could be your family friend investors, it could be the founders, it could be the employees, all that put together. But there's only one entity that will actually sit at the table and sign the term sheet, which is the company. Similarly, on the other side, there could be a syndicate of different investors. There could be 10 investors, 20 investors, but they all have now come up to the table with only one term sheet. And they are going to sign on behalf, they will also sign individually. But the point is, the transaction happens between these two larger entities. It's not between one investor and one product. It's all done at that level.
So, it's just probably general perspective on behalf. If you look at the common questions, it's about how much equity should I give an advisor, what is a shareholder agreement, what sort of agreements to sign. So one thing which I've noticed personally is that if you look even from India, we keep Googling stuff, we land up on Fred Wilson's page or Bradford's page. And they've done a fantastic job of demystifying the term sheet and the process, and even putting out actual numbers as to, hey guys, if it's an advisor, you should give X percentage. What I've seen in India per se is that you have scattered information. You have one your story which comes up once in a week. I know Let's Venture is doing these seminars across the board, but what you don't have is the culture of consistent blogging and putting out that knowledge and completely opening up that doors so that a lot of this information is already out there. And I think that's a huge gap in the ecosystem personally. I thought maybe Let's Venture and maybe people like you can demystify this for a lot of these articles.
So just to kind of add to that, because we saw the gap in the ecosystem, we've actually opened up our term sheets. So we have actually put it up on the cloud. So you can go to Let's Venture or you can write to us and we will send you a template term sheet. And we have used that template term sheet even for our own funding, right? So we really practice what we preach. So Axel signed that same template term sheet which we have put up on the club. I mean, our biggest institutional investor, right? So they went ahead and signed it. So we are doing that, but I think the advisor equity, there is no, again, formula, but I cannot hear.
The advisor equity is about what's the liquidation preference,
Yes.
what, what do you do,
Yes.
what's the tagline, right? I mean, it's all alien terms,
Yes,
people when they
absolutely.
say don't you.
Yes.
That's what I meant. Is there anything more? Thank you. Sorry.
Is there any revenue share between the company and the angel investor before exit?
No.
It's an equity investment, it goes out as equity payouts.
Okay.
Payout for the
There is no dividend and all of that. That's why angel investment is high risk.